Good morning, everybody. Welcome to the Flow Show. Here we are, cool, racing through this week. It's already Thursday. It's going quickly, the new year already. Morning, Kay. How's the speed of things for you?
Morning, Ryan. We've just put the Christmas tree aside. I'm planning to get it out again relatively soon. Time flies.
Yeah, soon be Christmas. Yeah, don't know. It's going too quickly for my liking. It's like the Back to the Future clock. Right. Anyway, let's get on with what's going on today. I don't know if this is a bit of trolling or not, but apparently, according to sources in China, Chinese investors are interested in the unwanted German car factories vacated by Volkswagen. Very unlikely that they'll be allowed to pile in and start building cars in Europe. That's the big bum fight going on at the moment. One of the big bum fights going on with China over vehicles. But it's apparently what they want to do, pile in and buy all those factories. We're still playing Bank of Japan games. A Bloomberg sources piece say that BOJ officials see a good chance of an interest rate hike next week as long as the arrival of Donald Trump doesn't trigger too many negative surprises. So they are I think they're the first major bank to report or to announce after Trump. And as we were discussing yesterday, we'll have one eye on what's going on. But we're back in that mode again, Kay. We're now expecting a hike next week.
Yeah. I strongly suspect Bloomberg journalists are watching our Flow Show because we spoke about what would be the conditions for a hike next week by the Bank of Japan. No later than yesterday. Yeah, I think we've got a bigger audience than we think, Ryan, and then they run away with what we are saying. We should really put it out to a bigger audience so the Bloomberg can't run away with what we are saying.
Yeah, or at least they should give us some accreditation, I think.
Yeah, absolutely.
They'd moan about it the other way. But yeah, we did have Ueda out again, but no difference to his comments from the other day. They will raise the policy rate this year if the economy, price conditions continue to improve. A Reuters poll has nearly 2/3 of 32 economists expecting a hike now next week. The remainder see a hike coming sometime in Q1, by the end of Q1. So everyone's looking for a hike, be it next week or over the next couple of months. They got a bit of help, small bit of help overnight. We had some PPI data out of Japan that showed PPI year on year coming in at 3.8%. Looks unchanged, but last month was revised up from 3.7 to 3.8%. So still positive numbers. Minor miss on the monthly number, but it's still all positive. So nothing cracking there, at least ahead of that BOJ meeting next week. Over in Australia, we had the jobs data out, and on a first look, seemed to be a really good set of numbers. Employment change coming in a whopping 56.3 thousand, much bigger than the 14.5 expected, and pretty much double what we got last month as well. However, when you look at the details, it's not looking as rosy as the numbers suggest. Full-time employment went negative, nearly 24,000. Part-time employment came in at 80,000. So it all went in part-time work, which potentially suggests it might be a bit of a seasonal factor, being Christmas and the likes, holiday hiring, etc. We obviously won't know that until next month, but it's possible we get a washout next month. The unemployment rate came down. The unemployment went up to 4.0% from 3.9%. Participation rate ticking up a bit to 67.1. So that's likely behind that move there. So overall, as I said on some analysis this morning, positive numbers are better than negative numbers, however they come. But there are, potentially some wobbles to come for the jobs market if that all gets reversed next month. It hasn't really changed much in terms of market expectations for the RBA. No one's moving away from cuts coming on that data, so we're still in that mode at the least. What do you make of that Aussie stuff, Kay? Reasons to be cheerful or brush it under the carpet?
Part one. I'm with you. It's on the face actually, and Bubble Boy made this comment in our room this morning as well. The unemployment rate came down as well from 6.2 to 6, but those are like very strange metrics, and the market doesn't really take them into account too much. They really react to those headline numbers. Yeah, that's we have to see what happens next month probably. But for the rest, I completely agree with you. I mean, on the face, pretty decent. I mean, we're not going to fret about 0.1 move in an unemployment rate. Yeah, I've also looked at it, and it's a bit strange that to see those reduction in full employment from one month to another. The prior month was a very decent 50K addition, and now from one month to the other you're losing 24K. It's all a bit. I'm going to say purely out of Aussie numbers of late. I'm very. It's difficult to say which path they are really on in Australia. Yeah, and the some metrics are coming down, so that could be that the RBA will be forced to cut perhaps a bit earlier and a bit harder than what people think. They have been so long on hold already. But it's difficult to say whether it's really going good or bad over there, and they are probably there's probably going to be a big reaction in the Aussie dollar as well next week when we will hear from Trump. And talking, if I may, just about the dollar, we do have a bit later on today Besant's hearing. So just a bit of an early heads up. I think we have to be a bit careful with all dollars today again. But yeah, the Aussie, I'm a little doubtful to know exactly how good or bad the situation is over there. If you look at it on the face, I mean, the 4% unemployment rate, it's somewhere in the middle of nowhere, right?
Yeah, absolutely. It's not too hot, not too cold. It's
Yeah.
where they would want it to be for the full employment. And I think you're right in terms of the jobs market. Yes, okay, that was a loss for full time this week or this month. But as you can see from these two charts, we're posting more positive numbers as a trend than negative numbers, even in the full time metric. Over the course of this year or last year. 4 negative prints, 8 positive prints. So, there's, even if we do get a bit of reversal in these numbers next month, it doesn't necessarily mean the jobs market's falling off a cliff. And like the US, that unemployment rate is going to be more important than actually probably the jobs numbers that we're printing. So if we take a quick look at that, we've been going sideways around this 4% mark. So probably unless we're ticking up above 5%, there's nothing really to worry about.
Go above 4.5 or below 3.5, and that's going to be the benchmark, it seems, right?
Yeah, absolutely.
Yeah, I mean, on the back of those numbers, I even don't see a trade right now in the Aussie.
Yeah, not at all. But doesn't stop the market from moving around as it likes to do. Algo's got an algo. Right, over in Sweden, Riksbank Steden says if the outlook remains the same, the policy rate may be cut again. So as we saw, inflation coming down earlier this week, so that will keep them on their cutting path. As we'll see when they decide to continue with that. Bank of England, all 65 of economists polled by Reuters see the Bank of England cutting in February and a total of 100 basis points in 2025. However, Bank of England's Alan Taylor thinks they might have to do a bit more. They say the risks around inflation have shifted in the last 12 months. Says inflation moderated faster than expected in 2024. Says the most recent data and forward-looking indicators present an increasingly gloomy outlook for 2025. The labour market is in near balance, but is still loosening at a pace. Says GDP growth appears to have ground to a halt in the second half of 2024. Then he goes on to say it makes sense to cut rates preemptively, and we may need a more accelerated pace of rate cuts, perhaps 125 or 150 basis points in the coming year. So pretty bearish, pretty dovish from Mr. Taylor there. He's set himself out as one of the big doves, Kay.
He must be short at 123 cable. Yeah, jokes apart, he's now starting to look like and sound like one of the new doves. He's probably seen those growth and everything numbers, and we can't really argue with some of his lines. And we've been talking about that, but now people are more looking at the risks for sterling and the UK than really the opportunities. It may or it may not end up being the wrong bet, but at least this is what we are in right now, and he's just kind of confirming. He probably has read also comments from certain sides of investors saying that they are still reluctant to really go all in on the UK. Perhaps it's a way of saying, yeah, we are going to try and get those interest rates to where you like them again. I don't know. It feels a lot like the central bankers are also a bit lost because they don't know what's going to happen starting next week. And in the meantime, they are now looking more at the weaker side than the opportunity side.
Yeah, exactly. I mean, probably the main surprise with that was that the pound didn't really move on it much at all.
Come off a little.
It's what, sorry?
It did come off a little, but not more than, for instance, the euro. And yeah.
Yeah, exactly. You know, there wasn't a huge move around that, which was a bit of a surprise because that is a pretty hawkish stall, dovish stall he's set out there. But you know, the market's already been going that way. You've got to think we've already had a big move in the quid, and you know it needs a bit more now. We know that what's going on with the Chancellor. We know what's going on with the economy. We know the Bank of England have already looked towards cutting soon. So, you know, we need a bit more to get some real downside for the quid continuing. But it may still happen. We're not out the woods yet in the pound. As you can see there from euro sterling, still remaining pretty bid on that pound weakness. His case was helped by the GDP data this morning. We had a small miss. November GDP expected to come in at 0.1%. Probably a bit of a saving grace for the accountant, Reeves, that it wasn't much worse. But, you know, these monthly numbers, they've been 0.1, 0.2, minus 0.1, flat for the best part, well, probably over a year now. So there wasn't a collapse in the GDP data. I think that's the best way to describe it. If there had been, then we probably would be looking at a bigger reaction in the pound. Industrial production and manufacturing production looking a bit soggy though in those numbers. They're not good at all. The 3-month rolling GDP number coming in at flat versus flat expected, flat prior, which was revised down from probably just above flat. So it's not looking like it's going to be a big growth quarter for Q4, but we'll wait and see when we get to December's data. Yeah, Trade balance as well, a little bit worse too. So nothing to write home about there. ECB Centino says interest rates will continue on a trajectory, ideally towards values close to 2%. Where they get to at 2%, he has no idea. Right, while we're talking about inflation and whatnot, let's go back to US data yesterday, good old CPI numbers. And I don't know, we're going to have a discussion about this because when those numbers came out, it didn't look like anything the dollar should get smashed on particularly hard. The only real miss was the core number coming in at 3.2%. Still, as I said, been saying, it's been running above 3% for the best part of 4 years. So nothing to get excited about. CPI did go up to 2.9%. So it is yet another month of higher numbers. Now, obviously, people get into what's going on underneath, under the hood. Services inflation, the much watched services inflation, that did fall back to 4.4% from 4.6% year on year. The shelter component of that came in lower by a pip as well to 4.6%. So moving the right way, albeit not very fast. However, within that services number, transport has a big say, and that rose to 7.3% from 7.1%. On the wages front, that came in a little bit better, or going the right way for the Fed. Real average hourly earnings year on year 1% versus 1.3% prior. Average weekly earnings year on year 0.7 versus 0.9% prior. So some cases to drive down at least the more hawkish expectations for the Fed. But Kate doesn't really change the picture. It's still higher inflation, still sticky inflation.
Yeah. We were kind of already correcting a little bit, and I think some have just taken those numbers as, oh, we need to correct even a little bit more, and then you find yourself on a bit of a level where people say like, oh, right, and then we look back at the numbers, it's maybe not that. I think there's a lot of really short-term trading, managing the books going on right now, Ryan, and a data point is an excuse to probably manage the books more. And then if you look at it, once the dust settles, take apart the yen because there's other considerations there. Everything is back at the levels, really, basically where we were before, give and take pips. When people are, if you look at 5 or 10 pips move, then there you may see moves. But if you look at the rest, only metals, yen have really moved. Perhaps Swiss just a little bit, but I mean, it's all when the numbers were digested, it was all like really as if not a lot had happened, right? And it's the intradays who have been trading through certain levels or capping other levels. Look at the 123 in the cable, the 103, just above 103.5 in the euro dollar now. All those levels have held. I'd say move on with in the back of our minds that whatever Trump does will affect inflation.
Yeah, absolutely. I think, we said it yesterday. During the show, we said it on Face. It was the easiest path to go with. Yields were already coming down before the data, and to pick some softer numbers out of it just gave the market the impetus to keep pushing that way. If yields had been up here somewhere going into that data, it might have been a different story, but we were already coming down. So it was the path of least resistance for those numbers, even though it doesn't change the outcome. So we've already, as I said, and I've been saying it since the NFP, we've made these highs in yields. It's the market's priced where the Fed's at, the data's at, so on and so forth. So it's going to need something more for that to continue. And at the moment, it's not going to continue. Inflation still, no, exactly. Inflation still went up. Okay, as far as the Fed's concerned, inflation went up. That's not what they want to see. So the fact that bond yields have come off a bit, it doesn't change the underlying picture. It doesn't mean we're going all the way back up, but it's got to do something more before we potentially see another leg. Whether that's next week or not, we shall have to wait and see. Bit more data. We had the Empire manufacturing number, which hasn't been much of a bellwether for the last year or so, but it still came in with another weak number, down 12.6, was expected to rise a small smidge to 2.7. Underlying components, prices paid has followed what we've seen in some of the other survey data. That went up 29.1 versus 21.1 prior. Employment, that moved into positive at 1.2 versus minus 6.6 prior. New orders down 8.6 versus positive 4.3 prior. We do get Philly Fed, I think, today, manufacturing.
Yeah.
We'll check that.
Correct.
So we get, cool. We get the next one on that. As far as rate cut expectations go, we are now pricing in a cut by July versus September previously, and we've started to reprice a second cut as well. We were down to one cut, just about as far as market pricing is concerned. So the old pendulum continues to swing. Fed's barking. Inflation is coming down towards a 2% target. He's not concerned about an overheating economy right now, says demand is solid but not booming. He can see past where inflation is sticky or continues to progress towards 2%. Latest CPI suggests inflation is still declining. He's not seen anything in long rates that would influence Fed policy. Fed Williams, not a lot from him, says monetary policy is well positioned for their economic outlook. Mr. One Print Goolsbeast says he still sees continued progress on inflation. He finds the CPI report somewhat encouraging and somewhat discouraging. So getting some splinters sitting on that fence. We had the Fed's Beige Book, which is like a economic assessment around the Fed districts and regions. The main headlines from that said that economic activity increased slightly to moderately across all 12 districts. Get into more detail. Consumer spending moved up moderately, driven by strong holiday sales. Vehicle sales were also up moderately. Construction and manufacturing activity decreased. High costs for materials and financing doing the damage there. Employment was shown to tick up a little bit. 6 districts reporting increases, 6 reporting no change, which again points to what some of the Fed heads have been saying, that there's been no significant signs of layoffs, just caution over further hiring. As far as prices were concerned, they increased modestly overall, and participants expected them to rise in 2025. And that's something the Fed will be looking at closely, particularly after some of the expectation surveys we've had, like the Michigan, which saw higher inflation expectations as well. Earnings season kicked off. Start with the financials. Some of the big banks all looking tickety-boo for Q4, so no real danger there, no real big shocks coming out, the majority of numbers from there. We've also finally got a Gaza deal, apparently a hostage deal, both Biden and Trump claiming credit for that. That must be said, both parties were at the negotiating table for that one, so a bit of a joint effort, shall we say. And as Kay mentioned, Scott Bessent is up for he's been nominated for the Treasury. He's got his hearing today, but he's already been out with setting his stall out, saying that they must ensure the dollar remains the world's reserve currency. US must secure supply chains vulnerable to competitors, and sanctions must be part of the whole government approach. Last but not least, Mr. Trudeau in Canada, still waffling, even though he's not going to be there for much longer, says they will respond forcefully if US imposes tariffs. Says everything is on the table when it comes to possible countermeasures in response to any US tariffs, but then says we don't even know whether Trump will impose tariffs, therefore we don't know what our response would be. Typical Canadian, by the sounds of things. Oh, last bit. Ukraine's Zelensky sees a higher chance of the war with Russia ending this year, predominantly due to Trump. And again, something we're all going to be waiting for when he takes over. Okay, any other headlines you want to bring us?
Oh no, Ryan. I think you've covered absolutely everything and more.
You can't say we're not detailed on this show, anyway. Yeah, that Besant hearing, that's at 3:30 GMT, if I'm not mistaken.
10:30 Eastern
10:30.
time. Yeah, I think so.
Yeah.
Yeah.
So yeah, 3:30 I'll probably be on kids pick up, so I might miss that excitement. Right, we need to look at what's coming up today as well, because we've got retail sales coming in, which is going to be important numbers, particularly the mood the market's in at the moment. December numbers, so this is going to close off that big retail period, and if that beige book is to be expected, we perhaps should be looking for a decent number from that as well. Retail sales expected to come in at 0.6%, so that'll look pretty good there. Some of those core metrics, core sales up 0.5%, stripping out autos, gas, and the like. So that's going to be the number to watch later on. You got any expectations for that data, mate?
Yeah, and I just want to agree with what Brad is saying. Like he says, that beige book used to be a mover,
Yeah.
but that was in the old days. Now it doesn't seem that the market is really taking too much of a notice of it. But yeah, it could be a front runner of what's to expect for the retail sales. We have seen that the American consumer has. For many months, or at least several times, defied the laws of gravity, or the numbers at least, and is doing better than expected. We had seen those Black Friday, but that was November, right? And stuff. Numbers being relatively good. But again, here between retail sales and Philly Fed, I would go with retail sales to perhaps being the more important mover.
Yeah.
Because the manufacturing, we know what the manufacturing is pretty volatile and lagging, or not doing too well already. So yeah, if you compare both, Philly Fed could be, the surprise trade could be a better number, and the retail sales a worse number. So what to do? I don't know. I'm just going to take it as it comes. But I would say, I mean, it would come out as a surprise if retail sales really print a negative one, right?
Yeah. I mean, it is possible. That's why it's a weird period. You can see a strong set of November sales, and everyone does their sort of Christmas shopping
Yeah.
in that period, and then it dies off in December. So that's, as I say, you can never rule out a wonky one in December if you've had a positive November. Obviously, double bubble bonus is if they're both good, and that really points to some strength. But yeah, I mean, the Philly, we know manufacturing's crap everywhere. So the surprise from the Philly Fed will be if it's a gangbusting number, well into sort of positive territory. But yeah, the retail sales will take the prize today, I think. Right, let's have a look at what's been going on. I'm going to start with yields here, because we have hit a bit of a level in terms of yield, which obviously means hitting a bit of a level in terms of price as well. But we had this level 464, 465, how you want to paint it. This prior high, when we came up here, we struggled, then we broke. Now we're finding it as a bit of support. So that as potentially will put the brakes on, further US dollar downside, particularly in dollar yen. But we've got a little bit of a divergence, deviation going on at the moment. Bank of Japan influence, I think, is becoming a bit more stronger in this one, as opposed to just following yields blindfolded. We've continued this move south. 155 is the big level down here, down to that fib as well, which is just a fib off the December leg of the current rally. That's a big historical level as well, plenty of action around there. So that's going to be the big one. If the dollar's going to pull up somewhere, that's where it might be. But it might pull up there if yields aren't breaking under that, or tens aren't breaking under that 464 level. If yields are going there, then I wouldn't put up much hope for that 155 level there right now. Okay, I think the question then we've got to look at, obviously the dollar's going to be moving around, data, Trump and the like and whatever, but are we still in a situation where it might be a bit of buy rumor sell fact on the BOJ?
Very much so.
And we've still got to find out how much they hike by. If they hike.
Very much so. And that's what I was saying past few days. I said I wouldn't be surprised if dollar yen or the yen strengthens a bit because of those messages sent out by half of the BOJ sources also. Also, I think what is playing here is, since we're getting closer to the Trump's inauguration, there is relatively little. Well, I mean, the market is trading as there's little chance that Trump goes very hard against Japan, right? Because of the partnership they have, because of Japan being one of the biggest investors in the US, companies producing in the US, and Trump has this he's a businessman, right? He's deal maker, businessman before anything else. So I think the market is trading that right now. So once we get over the Trump, and I would say that it is possible that we are going to look at lower levels still in all yen pairs into inauguration day. Then of course we will have the surprise whether he goes or he says something that Japanese may or may not like. But I think that's what the market is trading now. And then after that, we will move on to the Bank of Japan. And if you take all the rest away, it's as you say, they better deliver now, because if they don't, then the yen is going to get a severe knock on the head, I think.
Yeah, I'm just looking at the wider chart. That 152 is looking quite
It's still there.
down there.
It's still there. It's going to be there forever.
Yeah, indeed. But yeah, we've got a bit of cloud action down there. We've got some moving averages close by as well. You can see how pretty strong the 155 is, and the 152 is even bigger. So I think that'd be nice if the BOJ drive us down there with a hike. Maybe gives us a little last hurrah. I think if I'm going to catch a knife somewhere, that'll be it. As long as the dollar's not falling out of bed around the world.
Yeah, that's the thing, Ryan. That's the first one now is to look at what Trump is going to say, right? Because going really soft against Japan, let's say, for instance, comparably to the rest, it may not matter what rates or so are doing or yields are doing. I mean, the yen is probably going to strengthen a bit into the Bank of Japan, and then we will trade the Bank of Japan again. But I agree with the levels. I mean, the 151 and a half, 152 is still a bonkers level, and it's probably going to drive the next percentages if we get down there into the Bank of Japan.
Yeah, and that's the thing with trading. Obviously, 152 looks good when it's trading 155 and a half, but you have to ask the question when you get down there, why are we down there? What's driving us down there? And then make the decision about taking a trade on that one. Ali, what do you say about shorting dollar CAD and dollar yen? We all like things. I would have liked, and I was setting up, I had some offers in dollar yen yesterday. If we'd have got a hotter CPI number, I would have loved to have hit that rally. It wasn't to be. I actually bought the dip initially around 156.41 because I thought the data wasn't as bad as the market was making out. But I didn't like that trade, so I got out for an 8 pip loss. I folded it early. That proved to be a good move in the end, considering where it went after. I think I'm not a bear over the medium to longer term, but I can sense that we've perhaps turned a bit of a corner at least as we've been talking, going into Trump, going into the BOJ, that sort of thing. So, yeah, I think we'd probably rally sells are probably the way to go from now, maybe just to the end of the week, and then come Monday, all bets are off. It's really going to be a wild card because it is also a US holiday, so we're not going to have potential US traders reacting in full. They're probably going to be up. Other markets will be open, so it's not going to stop people trading. Do you think? I know markets are shut, but I would expect that the US desk will be manned for that. It's not something they'll be sitting with their feet up eating.
No, obviously. Obviously, I mean, I recall from my banking days, whenever something, and then let alone a Trump inauguration, but
Yeah,
whenever something, we were up and we were actually at our desk. Even when I was in Japan, it was like 10 o'clock or so in the evening. We were still there on US Fed or whatever employment data. Also, I mean, all the desks will be manned. In the knowledge that manned these days means a lot less people than before. But yeah, I mean, everybody will be on high alert for such an event because
yeah,
of the potential of such a big move. No, it's not really vultures, Bran. I mean, if in the days, if we wouldn't have been at our desk when a client needed us on a big data number, we would have lost the customer. I mean, it's nothing to do with vultures. It's our clients who were putting the pressure on us to be on our desk as well. Not only us, not only
yeah.
us trying to make money out of it.
Yeah, it's necessity. That's the job. If
Exactly.
I worked plenty of UK bank holidays because everything else was open.
Absolutely.
We've all been there, seen there, done that. You keep your nose to the grindstone. Business is business, and yeah, you may get the ump because you missed a bank holiday, but there's also that you've got to be there for it, and so sometimes it was good to be in and working. Right, so that's Dolly Yen taking care of for now. All the rest, we're still in this situation, and I'm going to look at cable if my button starts working. A lot of pairs in the same boat. We've seen these lows made. We've seen a bit of a bounce. It's had its moments, but it's not really. We're not out the woods. We keep using this saying, "Okay, we're not out the woods. We're not out the woods," but it's a true saying. Again, you've got to look at the context of some of these moves. Cables come down from 134. 100, 200 pip bounce is nothing in the grand scheme of things. It is performing maybe slightly better than some of the others in terms of stepping up of support. We've had 3 step ups now. We're trying to hold this 122. If it does, gives it a bit of impetus to maybe look up at the high side again. But we had this, 122, 40, 50s resistance. We had the poke above on the data and whatever. Didn't last. We're back below and holding below. So, we got to. The battleground is tightening up a bit. It's either going to break above here or it's going to go back below here. 50 pips is not a lot for a cable to move around in. So something's going to happen at some point. So whether you're bearish or bullish, doesn't matter. You can just go with whichever side breaks. If we break down, you've got to watch these prior lows because that's clear indications where buyers have been sitting. If we bounce off of that, again, might give it the springboard to then go and take on this 24, 40, 50. But otherwise, this trend that we've seen is not for changing yet, and we're still getting lower lows. We've just stopped getting lower highs. We just stopped getting the lower lows for the moment, but we've been here plenty of times before. Euro dollar, same sort of picture. I mentioned this 102, 77, 75, 80 level. We had a little flush yesterday afternoon, but here we are back above it now. So it's got a bit of a base. It's trying to build here again. Another 1, 2, 3 type pattern that we had down here as well. So, but again, we can't get and hold over 103. Can't get above 103.20. We've had this little move up to here, so this is the bigger area, and we definitely ain't getting through that on the first look and coming back very, very quickly. So A lot of numbers all looking the same here. Euro sterling, as I've been saying, this is probably your more pound looking trade, or if you want to keep a closer eye on the pound. We're holding this 84. I'm not doing anything at the moment, but I would think about maybe tapping the 85 level just on a technical standpoint, maybe trying to short into there. It is the bigger level. Oh, I need to go under a daily for that one. It is the bigger level amongst all these. So that's the one I'll be looking at, maybe to try a bit of a technical fade against this move. But if it shoots up through there pretty quickly, then probably something's going wrong again in the UK. Dollar CAD quickly, and then I'll pass it over to Mr. K. Let's have a look at this one. We're still doing this sideways stuff. Yes, mate.
Yeah, while you're putting it up, just want to remind people that Ryan was talking about what kind of counter measures Canada could come up with. This should be, and together with the mix as well. Maybe we'll have a look at the mix tomorrow to see what may be possible. This could be a really big mover over Trump's inauguration. Okay, I mean it depends what he says day one and day two, because since the markets it's a US holiday, we also, and I've been thinking about it, we also may take into account that he may wait until day two to start waving around with a lot of executive orders, right? Yeah, this is one I would say on the cat. If you have a cat position, be careful what you do right now. And if you plan to keep it in your inauguration, know that you are going into a completely unknown, because he could go very hard against Canada, or he could say like, you've got as much time to do something, and your dollar cat could move 150, 200 points. Why not? Just on Monday and Tuesday, right?
Yeah, I think that's it. Protect your risk. I'm certainly, if I'm in any dollar pairs by the end of this week, I'll probably look to fold it unless I've got enough margin in a trade that I can ride out some moves against it. But yeah, lock in your stops at least, I would suggest, if you've got any dollars on going into the inauguration. But yeah, just looking at this quickly on the short term, we're still in this range. We might be extending a little bit down to the 142s, but as you can see, we're back above this 143.40. Not really looking like we're going to challenge the highs. So yeah, this one just looks coiled for a move, in my opinion. As Kay says, Trump could be the decider. We could be at 140 or we could be at 146. Who knows? I guess we'll find out soon enough. Right, mate, I'll punch it over to you.
Okay. Yeah, I'll have a quick look at what's going on in that Swiss for you. But for the time being, it's really, for me, not doing too much, but consolidating. Sorry, the latest gains. Just I'm always keeping an eye on this one, which held a good number of times. Support now is around 3.5, around 93.5. Yeah, rallies have been sold. I think a lot to do with potential uncertainty around Trump, the continuous weakness of European data. So yeah, we are in a bit of a triangle here, right? I guess if we get back above 94, 10, 20, we're going to retest those 94.40s. But as I said, this is where really it will have to break because going back to November, that's also 94.45. So for as long as we're below there, I think perhaps range until Trump comes in. It does look like we find sellers on rallies here, yeah. But do we hope for a lot? I don't know. I think it's also coming down a bit in sympathy with what the yen pairs are doing. Like let's not forget that all yen pairs are lower because of speculation now that the Bank of Japan may do something, and that Trump will be very how shall I say, soft on Japan, and the Swiss may just trading sympathy with it. Haven't seen too much on the Swiss to justify bigger moves either. You know my view here on the dollar Swiss. We need to break 92 and a quarter, 92 and a half to really continue to go. Longer term, I think that we are going. Yeah, just for the sake of giving some thoughts that other people have. You see, we have done here now. This has been quite strong around 92 here, but longer termers think that we are going to go back up to levels around here. That's I'm just giving it to you how I read it and I see what people are saying. I just want to see it break first before saying like, okay, this is continuing to go. I don't see any reason to buy Swiss franc. That is one thing because the S&P is still not on high alert, but still monitoring the markets. I think any prolonged Swiss strength will be met by some interventions, in my opinion. If you get back down to levels around 88, perhaps that's they won't like it at all. But in the meantime, we need to break above this 92 and a quarter, 90, 92, 92 and a half, yeah, to continue to go. Um, Gold and whoops, what happens here? And you had a question about why gold is higher. Well, okay, Marcus gave a good Marcus gave a good a comment there as well, that people, when you are afraid of higher debt, higher spending costs and spending needs, gold is one of those instruments that rallies. I also think that, and a bit linked to that, if Trump slaps tariffs on people, gold is probably going to be one of those trades of 2025 that is going to continue to rally. Now it all depends what we are going to get in the first few days or weeks. If Trump in turn is quite soft and the market takes it as very positive, those hedges that we have in gold in the market for sure now. I also think about Asians are probably have been buying gold as well to as a hedge against potential, let's say, higher dollar China or so. You don't want to keep Chinese yuan if Trump goes all gangbusters against China, and this is then going to pull higher. So a lot of it is a hedge against risks, Ali. But I don't yeah, that's what I was going to say. If you look at the dollar and you're bullish dollars, forget about trading gold or silver on the back of the dollar unless you've got an economic situation which is muddling on, not muddling on, but which is like just simply zooming on. Everything is going quite okay without being like a very big upside or very big downside. If everything is like really, really average and just zooming on, you can trade those metals on the back of the dollar because they are going to follow yields, they are going to follow the dollar moves, they're going to. But in situations like what we have now, which with Trump upcoming, potential big variations in things, and even in economic situations, not only in the US, but it's going to have an impact on the world growth. It's those are days where you look at gold as gold, or you trade it as a hedge against something else, and you don't look at it as gold versus dollar. You could actually, for instance, be long gold against euro because it's the same thing. If Trump goes hard against Europe, I mean, gold euro is probably going to shoot higher as well. So I mean, don't stare yourself blind on the second part of this pair here, dollar. Okay, trade the first part of the pair, gold. All right. So that's just what I wanted to say. And on silver, we're trying here. You know what I've been saying for a long time. I'm still long-term long, but I'm a bit more cautious on silver than gold because silver is going to need a decent economic backdrop. And if we get that, let's say for instance that Trump is softer on everything tariffs and stuff, this could actually really fly. But and gold and silver will outperform gold in that case, okay? But we still have to wait here. In the meantime, yeah, it's doing what most of the metals are doing, and going a little bit higher. I'm still happy to keep it for now, and we'll have a very close look if Trump puts in tariffs. What's happening again around 20, somewhere around between 29.60 and 28.5. If we form a base there and then go higher again, or if there's a lot more risk in the markets, and then we could actually go back and see 26s potentially. All right, but for the time being, wait and see. And now, back over to you, Ryan. I'm done for today, mate.
Thanks a lot, mate. Great stuff as always, and we shall call that a day. As always, thank you for coming to the Flow Show, watching us here, giving us all your opinions and your thoughts. I hope you have a good day, and we'll see you later on Face, or we'll see you tomorrow. So have a great day, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.